Good afternoon, everybody. Welcome to the Masonry building here on Thomas Street. It's one of Iconic's buildings, and I'm joined this afternoon by Paul Kenny. Paul is today representing the Retirement Planning Council of Ireland, and I'm delighted to welcome you, Paul, this afternoon to this chat, hopefully over the next 15 or 20 minutes. The topic today, Paul, we're talking about is planning for retirement 10 years out, something which is near and dear to all of our hearts. But unfortunately, I think in this country, maybe not enough people's hearts. Is there anything, Paul, you could tip you, or you could give us in relation to planning at that stage?
Planning at that stage, there's a number of things that come up. First of all, I suppose the part that most people see about retirement is the financial piece. Am I going to have enough to live on? What am I going to do about that if I don't think I'm going to have enough to live on? So the thing to do, first of all, is to do an audit. What kind of retirement property do you have? And I don't mean real estate necessarily, but your accumulated pension or pensions, as the case might be, if you've moved around and so on. Have a look at those. Have a look and see, okay, can I project forward and see if I get, say, a return of 4 or 5% on that for the next 10 years, what will it amount to? How much of that will I be able to take tax-free? How much of it will I be able to invest post-retirement, either by buying an annuity or by taking out an approved retirement fund? That's the financial piece. And then if the answer to that is negative, you're still worried about what the fund is going to be like when you retire. Can I put more money into this? Can I take advantage of the tax breaks that are there? And
just on that, Paul, is there any limits in relation to the amount of money that you can put in?
Yeah, the limits for an individual are age-based. So if you're under 30, for example, it's 15% of your gross earnings. Mm-hmm. Then it goes up to 20, 25, 30, and eventually to 40. Once you get to age 60, you can put up to 40% of your income. But it's limited to a maximum income of 115,000 for tax relief purposes.
Is there a limit that you can actually have accumulated in the fund?
There is a limit to, the revenue have limits as well, overall limits on what you can accumulate. And if you accumulate a fund of more than €2 million,
2 million sounds a lot of money.
You're going to be taxed fairly heavily on any balance.
Is 2 million considered a very large fund, or?
It's a more generous fund than they have in the UK, for example. The UK is a bit over £1 million, their limit. So we are actually quite generous. We're generous on a lot of fronts. We've got more generous social welfare benefits as well than the UK have. And you've also got to take into account, are you going to expect a state pension contributory? If you're an ordinary employee, you've probably been contributing Class A, PRSI forever and ever. Yes. And you'll have the contributions accumulated, which will get you a state pension contributory, hopefully at the maximum rate. And
then, of course, maybe your expenses have changed since in the last number of years.
They will undoubtedly
Family
have changed.
Grown up, or mortgages have been paid off.
Mortgages have been paid off. Family have grown up. Hopefully, flown the nest. Yes. Not necessarily, but hopefully. Yeah. Then you're maybe in the space of considering downsizing. One of the things we don't recommend is that you move house at the same time as you retire. Right. You don't need the hassle of both at the same time. No. But if you have space to step back and say, have I the potential to downsize? And most people want to downsize in their own area, which is a bit of an inhibitor, if you like, because very often the properties that are suitable for downsizing in may not be available in your general area. Most people don't want to move out of that comfort zone where they have neighbours and friends and the parish and whatever, and the golf club.
Yeah, and then when you get to retirement age, Paul, I mean, the issue of inflation has been out of our minds for the last number of years, but it's steadily creeping back in over the last 6 months. It's very noticeable. I mean, inflation, I would imagine, plays a big part in what you're going to when you have accumulated your assets.
It does, and an awful lot depends on what kind of pension scheme you're in. For example, if you're in one of the what are now old-fashioned defined benefit pension schemes, there may be built-in inflation protection as part of the deal in those schemes. If you are in the situation of buying an annuity with whatever is not tax-free when you reach retirement, you have the option of taking a smaller nominal pension but with built-in inflation protection there. The revenue, for example, will allow you to have 2.5% compound inflation built into your annuity. But it means that the nominal value of the annuity is going to be smaller when you start.
Yes.
Then you've got to think about the possibility that you might be outlived by a partner.
Yes.
And do you devote some of your pension pot to providing something for them?
Yes.
In retirement? There's a lot of things to be thought about.
But there is an element of that pension fund that you can get tax-free. Is that right?
There is. In general, in the orthodox pension fund, if you like, it's more or less the same as it has always been in the public service. You can have a maximum lump sum of 1.5 times your final remuneration. Okay, and that's basically what a long-serving civil servant will get. If you can get that if you've more than 20 years service. You don't have to have the full 40 years service to get that. You can have it after 20 years service. And this is where the possibility of additional voluntary contributions comes in. Because the rules of your scheme may not permit you to get the maximum lump sum at retirement under those rules. But if you have additional voluntary contributions, you can top up the lump sum.
So your employer and your employee contributions may not be sufficient to get you to the target level you want.
Correct.
But you can contribute additional contributions yourself.
Correct. And get tax relief at your marginal rate on those contributions.
Right. And then investing those contributions, is it your choice of which to invest those? Or
generally speaking, it depends on whether you're investing them via your employer's pension fund or not. What happens is that in a defined contribution pension scheme, for example, the employer will have, the trustees will have given you various investment options that you can choose from. But they're also required by law to have a default option. So if you don't feel up to making the choice yourself, there will be a default option which will take over. Right. And do the investing for you, if you like. If you don't feel competent to make the guesses yourself, if you like.
And the risk level that you're taking at that point in your life, is it important to monitor that on a regular basis?
It is important to consider that because, as you say, circumstances change, and the capacity that people have for risk probably diminishes as they get older. They get more conservative, let's face it. Yes. If you're young and time is on your side, you can take chances. You can invest in largely equity funds, and provided you're well diversified, the risk is fairly minimal. And as long as you don't confuse that with volatility, because investment funds go up and down, but as long as you don't panic, you're probably going to be okay in the long run.
But presumably when you get to retirement age and you've taken that tax-free cash, you can then reassess the risk depending on your mortality.
You can,
going forward.
Yeah. I mean, you have the choice then. If you're in a defined contribution scheme, you have the choice of going the orthodox annuity route. So you can say, I want to play very safe with this. I want to guarantee my income for life.
Yes.
And I'll buy an annuity. Now, interest rates are low at the moment, so annuity rates are poor. Mm-hmm. But if inflation takes off, maybe interest rates will go up and annuity rates will improve. But as things stand at the moment, annuities don't seem to be terribly attractive because you're locking yourself into low interest rates for life by buying an annuity.
And for those people who are not lucky enough to have been in defined benefit schemes and they're in defined contribution schemes, is there a maximum tax-free cash lump sum that they can avail of before they then take their benefit?
No, they take their benefit at the same time as the tax-free lump sum. But the first thing they can do is they can opt for the 25% of the fund tax-free.
Right.
Okay, up to a limit of 200,000.
200,000.
After that, there's tax to be paid.
Yeah.
But before that, under 200,000, you can have a quarter of the fund. So if your fund is 800,000 or less, you can take a quarter tax-free.
So I suppose the message here today is really, you have to assess what have you got in your assets so far. now that you're 10 years from retirement age, see what the maximum level of benefit you can have, and see can you fill that gap.
Exactly.
If that's possible.
And then when you do get to retirement, if you've taken the 25% tax-free cash, then the route is open to you to go into what's called an approved retirement fund, which is a post-retirement investment fund.
Yes.
And what happens with that is that you lock it away, you choose how it's going to be invested, diversify all you like, and it's there for as long as it lasts. Okay. Now, there are a couple of little catches, if you like. First of all, if you don't have a guaranteed pension income of 12,700, which is a little less than the maximum rate of the state pension contributory, okay? So if you have a state pension contributory, you will have that.
Right.
Otherwise, you have to lock away 63,500 of your fund into what's called an approved minimum retirement fund, which is not released until you reach that magic 12,700 target or you get to 75.
I'm hearing through the grapevine that there's a possibility that that restriction may be removed shortly.
I hope it will, to tell you the truth. But the other restrictions that are there at the moment is that if you're under 70, under 71 in fact, you're going to be taxed on what they call a deemed withdrawal.
Right.
So whether you take 4% out of your fund or not every year, you'll be taxed if you had.
Okay.
Okay, and this is the revenue finally cotton on to the fact that you could have in the old days deferred taking down your money indefinitely, and they were getting nothing.
And Paul, is it true that if you did manage in your lifetime to accumulate the maximum of, which I believe is the order of €2 million in your fund, that with current interest rates the way they are, that you could be transferring that in, if you were to buy an annuity, into something like 3%, and that technically speaking, your 2 million is only worth about 30,000 per annum.
Yeah.
Yes.
Yeah.
I mean that's that's quite severe.
It is. Yeah. No, it's very punitive. That's why the ARF option is so attractive to a lot of people.
Right.
I have to add, by the way, about the deemed withdrawal thing, that it goes to 5% once you're over 70. Right. You hit your 71st
just when
birthday.
You didn't want it.
Just when you didn't want it.
Right.
But otherwise, it's yours. It's flexible. So if you meet an unexpected expense, for example, and you need £1,000 in a hurry, it's there in the ARF and you can draw it down subject to...
And this is precisely the point on expenses, because your expenses at that time of your life have the tendency to change. You probably have no mortgage, or you have very little left. Your children have probably flown the nest, as you say.
Yes.
And they hopefully not too much of a burden on you anymore. But now things like your medical insurance become your new mortgage.
They do.
And these expenses have to be looked at, and planning has to be done well in advance of your retirement. And that's where the 10 years, I suppose, timeline kicks in.
You can change your habits over 10 years. You can, for example, decide that you're not going to pay your car insurance in a lump every year.
Yes.
Like you always did.
Yes.
And you can spread it. And you can shop around and find the insurance companies that will allow you to spread it without charging a load of interest.
Yes, so you really need to be talking to a financial advisor in relation to the actual planning of your expenses and your income for that day down the road, which is going to inevitably going to come.
That's right, and shop around, get the discounts.
Yeah.
There's a certain company which I won't name in the hardware builders providers type business who'll give you 10% on a Thursday for being old.
I'm sure, Paul, you know all the tricks of the trade.
And, well, there's a lot of them out there, and then of course in the old days they used to say that every Irish village had a church at one end and a GAA club at another. Now there's a little at that end and an Aldi at the other.
Yes.
And shopping around is a very good idea. Get the discounts. Get the €10 off 50 and all of those kind of things.
Yes.
Because once you're retired, you've got time.
Yes.
24/7, 365 is yours, hopefully,
yes.
if you haven't mortgaged it.
Yes.
And this is where another warning that we give to people as well. Don't blindly rush into things like caring.
Yes.
And that sort of thing. Think about what you're being asked to do and then ask yourself, would I be still up for this in a year's time?
Yes, exactly.
Or will it be a millstone around my neck?
But the whole issue of the 10-year out really is a crucial time in your life, You've really got to look at this because, let's face it, nobody else will do it for you.
No,
It's
that's
not going
right.
to happen.
And you know, we have found certainly, and I have to credit my wife with this. She's the one who does the phoning and everything. Talk to the insurance company. It's very rare that you won't get a reduction on the renewal premium that they've advised you.
Okay.
And also shop around for the best kind of health insurance. I mean, sometimes you can find that by taking a small excess per claim, that you can reduce the premium quite substantially.
Yes.
You know, there's those kind of things that need to be looked at, and doing that in the run up to retirement is a very good idea because you don't want all this to hit you at the point
Speaking
of
of
retirement.
that person behind you, that Marvelous, who's doing all your financial planning for you at home, is there anything you can plan for in retirement that in the event of you passing away, that there might be something for your spouse in the event of, you know?
Absolutely. And the thing is that if, for example, you have bought an annuity, you can tie a spouse's annuity into that. If you are in an ARF, whatever is in the ARF will accrue to your estate. Now, the one thing I will say is, if you have an ARF, for God's sake, mention it in the will.
Right. Yeah.
Treat it as if it was cash,
Yeah.
because it's cash equivalent, because it doesn't automatically fall to your spouse. So if you've made all kinds of bequests and everything, and you haven't mentioned the ARF, it goes into the residue of your estate.
Right.
And you might have left that to charity.
Well, Paul, it's been very informative today, and thank you very much for popping in to see us. I've no doubt we will get together again in the near future.
I hope so.
And hope you're enjoying retirement, and I know I am. Thank you very much.
Thank you.